Hi everyone, Joe Gentili from Left Tail Risk Advisors. So this video is for families that have set up special needs trusts and are funding, at least partially funding those special needs trusts with life insurance. So first, I want to commend folks and congratulate them for doing this much planning. It's a lot of work to set up a special needs trust, and it takes a lot of effort, money to set it up to fund it with life insurance. So that is excellent. However, um, unfortunately, you're not finished at that point. It's very important for any life insurance policy when you buy it that you want it to be there to pay when the people it's insured pass away. I don't think there's any scenario I could think of where that's more true than when a special needs trust is relying on funding from life insurance. And life insurance products are not set it and forget it. They need monitoring, some types of policies more than others. So if you have a special needs trust and you have life insurance funding that special needs trust, it is very, very important that the policy that you have funding the trust is regularly monitored and looked at by a life insurance professional. The reason for that is because problems in life insurance policies frequently develop very slowly. They're not necessarily obvious to somebody that doesn't have a trained eye for this that there's a problem developing with it. And by the time that problem becomes obvious, it can be very expensive or impossible to fix. And an attorney, we've represented folks and we've worked with many folks that have had life insurance policies. They paid the premium they were told to pay for nearly their entire lives into their 70s and ended up having to lapse the policies with no death benefit paid out. Very, very bad situation, catastrophic situation if it's in the special needs context. Where you really want to pay special attention to this is where you're funding your special needs trust with any type of universal life insurance policy, particularly an index universal life insurance policy or a straight universal life insurance policy or variable universal life. And the reason for that is because with those policies, the premiums or the amount of money that you're paying into the policy typically does not guarantee that the policy is going to stay in force. Usually, the amount of money that you're told to put into those policies relies on assumptions. And those assumptions in the illustrations can sometimes be overly optimistic. And even if they're not overly optimistic, sometimes they're just missed. And if you're missing on those assumptions, you start to develop early on these small deficits where maybe the cash value is going up, but it's not going up fast enough. And over time, with universal life insurance policies, they get more expensive to stay in force. The amount of money that the insurer takes out of the cash value to cover the cost of insurance goes up every year. And if you're not mindful that the cash value is not going up, that you're not funding it to keep ahead of that, by the time you catch it later on, it could be a massive amount of money to keep the policies in force. So especially for those types of policies, it's important to have people monitor it because if you catch this early, it's fixable. You could put more money into the policy, maybe you could port to a different policy, but it's a fixable situation. Not as easy to fix when you get later on. Other types of insurance need monitoring too, but it's not as important or is not as critical because with universal life insurance, what you're really monitoring for in part is premium sufficiency, that there's enough money there to keep the policy in force. Whole life insurance, for instance, you still need to monitor it. You need to make sure that the amount of coverage you have, for instance, still makes sense for the need that you're trying to cover. Is there enough coverage there? Is there too much that does that need to be adjusted? Still needs to be monitored, but they are simpler to administer because they have guarantees in those policies where as long as you're paying the premium, the policy stays in force. So you don't have to necessarily worry with those policies if you're paying for them that they're going to lapse at some point, even though you're paying, which you do with universal life. And then you also need to monitor term life insurance policies. Most term life insurance policies in the special needs context, you may have them there as a placeholder until you could afford to get more permanent coverage. And so the conversion privileges in term life insurance policies are very important in this scenario. The term conversion options may expire at some point before the term does. So you have to be mindful of the amount of time that you have to convert. You also have to be mindful of whether the products that the policy you have that it lets you convert into are good products, that they're adequate, because sometimes they're not and sometimes they are. It's really a policy by policy question. So all life insurance that you're using to fund a special needs trust needs to be revisited from time to time. Some types of policies, though, it's more urgent. And again, if you have a non-guaranteed universal life insurance policy or an IUL that you're using for special needs trust funding, I strongly, strongly encourage you to have those policies reviewed by a professional on a regular basis to make sure that they are being funded adequately to stay in force for life. Because again, there is no situation I could think of in the life insurance world where it's more critical to have the policy stay in force for life than with special needs trust funding. Any questions on this topic, I really encourage you to reach out. And if you found this useful, please like and subscribe for future videos. Thanks. Have a great day.